Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host Neil Gibb, and I'm back in the studio with my good friend and guest from episode 6, Julie Taylor. Welcome back, Julie.
Thank you, Neil. It's great to be back.
It is a pleasure to have you back. We have a lot of good, long, lengthy conversations about a lot of good... The amount of times we've had conversations, I said, God, this would make a great podcast, or this would make a great podcast. And although Julie's been a guest on the show, she's also an avid listener. Mm-hmm. And she rings me up after some of them and starts asking me certain things about the things that we've been talking about, which challenges my thinking. And then Julie said I also challenge the way that she thinks. So we thought we'd do a podcast today for all of these people that are equity rich and cash flow poor, or in a position where they're considering what the next step is. You probably got a portfolio of some size, whether that's one property or 5 properties or 10 properties. But I think anybody that's listening to this will probably get some value from it. So I would recommend getting a pen and some paper and making some notes. And we've also got some slides. So if you go to the YouTube channel, you can check the slides out on YouTube. Press pause. There's going to be a lot of information in them as well. But myself and Julie are going to be talking through them and picking it to pieces, aren't we, Julie?
Absolutely. And we'll try to describe what's on the slides. So the slides are really there as my cheat sheet.
Yes.
Because there's so many numbers involved in this conversation that I can't remember the numbers, and my mental arithmetic's not quick enough.
Me too.
I just also wanted to point out that I've been here for 55 minutes and we haven't even started recording.
Well, this is pretty standard for us, though, isn't it?
It is.
Like when Julie calls me, I see it's on my phone. I'm like, do I have 30 minutes free to talk to Julie? But then I always ring you back when I'm in the car or when I do have time. And we do have some really good conversations, so I appreciate it. Yeah. So today, the slide that we've got on right now says making the right investment decision for you, because I'm speaking to more and more people that, again, like I said, are equity rich and cash flow poor. Lots of people are seeing lots of capital growth, but they've also seen interest rate changes, which is stopping people from borrowing more money, and also stopping people from accessing equity from their portfolios as well.
Yep. I'd also add to that, there's quite a lot of property gurus around, including yourself, Neil.
Thank you.
But everyone's got an opinion about what people should do.
Yeah. And
quite often that leaves investors in a point of confusion. And hopefully this conversation that Neil and I have today will actually help people work out how they can make the decisions for themselves.
Yeah.
Because I think ultimately you have to own what you're doing, and it has to fit in with your lifestyle and what your goals are.
Yeah. And it's probably a good position in the podcast to say we're not financial advisors or financial whatevers. We are just 2 property investors that have done all right for ourselves, and we just like sharing our knowledge. One of my mentors always says, when you get to the point that you want to be in, always give back and always help other people. And I've got a very, very strong passion for doing that as well. Obviously, I can't help everybody. It's only so many hours in the day, right? But you're exactly the same, Julie.
Yeah, absolutely. Yeah. It's I would like to see more people become financially independent from their property investing, and not enough are. And I think there's a lot of negative press at the moment about greedy landlords, and I'd like to push back on that largely, and have other people in a position where they're confident in pushing back as well.
Yeah. Okay. Well, let's get through to the slides. So what provoked, or what Julie reached out to me about, is I said we had a client, or somebody reached out to me that had a substantial portfolio, $7 million worth of property, $3 million worth of equity, $35,000 a year cash flow negative. This was while interest rates were relatively low, so I would say that's probably $70,000 to $80,000 negative cash flow right now, which is a substantial amount of money to be losing every year, even if your property portfolio is increasing at 10% per annum.
Yep.
And what we're going to talk about today is, I don't want to jump too far ahead, but we've skimmed through some of the slides already, and there's properties there that they might have already done the job for you, and you might need to look at how hard they've done how well they've done, and then what you can do with that equity.
Yep.
And sometimes we call it opportunity cost scenario, right?
Yeah, absolutely. Yeah. And this is quite a common problem. Like, you talk to a lot of different property investors and they get to a position and they just get stuck and they don't know how to solve the problem for themselves. So we're just going to talk about the sort of process I go through so that I can force myself to make decisions. Because often with property, it's quite emotional and you don't want to sell one of your children. And sometimes you might actually have to.
Yep.
The other point that I wanted to make is, to me, or I learnt eventually, that property investing is really just a business. And as soon as you own a single investment property, it is a business, and you need to start approaching it in a business fashion.
Yep. And we don't set up businesses to lose money every year, do we?
No, we don't.
So that's an expensive hobby.
You'll go out of business.
Exactly.
Absolutely.
You said there you see a lot of people that get stuck. What's the most common stuck that you see?
Lack of cash flow.
Lack of cash flow. And that stops them from...
That lack of ability to lend.
Yep.
So lending stops, and lending generally has stopped because cash flow isn't there.
Is there a certain number of properties in a portfolio we see around there?
No.
Could be two or three?
No, nothing. Could be anything. I've talked to people that can't get started because they don't have high enough income to go and get their first property under their belt. But I've also spoken to people that have got 2 properties and they can't seem to get any further.
Yep.
And I've spoken to people that have got 10 properties and they want to keep going and they can't. And it's just trying to understand that mix and how do you resolve it.
I wish I had the statistics now around how many property investors own 1, 2, 3, 4 and 6. I think there's something like 1% of property investors own more than 6 properties.
Oh, I think it's lower than that.
Is it lower now?
Yeah.
Crazy when you think about it. But the amount of property investors that are out there is relatively low as well.
Yep.
When you're in the property investing space, you feel like everybody's a property investor. But when you remove yourself from that space, it goes somewhere else.
I think it was something like only 76% of property investors go beyond 1 property.
Something like that.
It's really high. I can't remember the exact statistics, and it's probably changed.
I'm pretty sure it is 1% of property investors own more than 6 properties.
Yeah, I think it's less.
Is it? Yeah, okay. Okay. So before we get into this, there's 2 questions that we need to ask.
Yep.
And 2 answers that we need from them questions, right? What are they?
Yep. So to me, by treating it as a business, so if anyone's listened to episode 6, you'll realise that I have a management consulting background, and it took me quite a while before I started to apply that management consulting experience to my property investing. And there's 2 things that I realise that I now do naturally that most property investors don't do. And the first one is to have some sort of vision or strategic plan for the future. And the second one is that you have to measure. And I know in a conversation that you've repeated, you can't manage what you don't measure. Yeah. So anyone in business will know that you need to be able to have measurements associated with your business. Yeah. And it's the same thing for property investing. And we're going to go into those measures that I use in this conversation.
What are the kind of visions or the plans that people need? What do they need to understand what they want? Is that on the next slide?
We can talk about it now. You can talk about it at any point.
Yeah.
To me, when I talk about a vision or a strategic plan, the most important thing to tackle first is to understand why you're doing it. So why are you choosing to invest? And you need to know what your why is. And at different points, I've done well in my investing, and then I'll just go through a flat point, and I'll often have to go back, and it's often because I've met my goals, but then I've got to reevaluate, what's my why? What is going to help take me to the next level? And what is the reason behind going to the next level? So why is really, really important. You then need to take your why to a what. So what is it that you're trying to do? And I don't know, your goals can be, people can have completely different goals. The what can be things like, I want 100K of passive income. The what can be, I want to be financially free by the time I've hit my retirement when I'm age 65.
Yep.
So you need to have the what. I've also worked out that when you have your vision, it's quite useful to have some understanding of how you want to do it. I'm surprised at how many times you talk to people and it's like, yep, we want to be investing in shares, or we want to do residential property. And so if you know that's what suits you personally, then that really helps. You know, it might be, I really want to do renos of properties. That's good. As long as you know that, then you can work out how to actually deliver that vision and how you're going to go about doing it.
What are some of the whys that people have?
You might know these as well as I do. Generally, it's around a financial independence.
Yeah. I speak to lots of investors, obviously, with the business that we've created. We help investors build wealth and cash flow, etc. And I speak to a lot of investors, and some of them have got good portfolios, some of them are in good cash positions, but I'm surprised at how many people don't actually know why they want to invest. What's the outcome? What is the goal? How do you know when you've reached it? How do you know when you stop investing? How do you know when to give yourself a pat on the back for getting this far? And your why can change as well over time, right?
Absolutely.
As you grow as a person, your why can probably change too. Well, what I do know is once you know your why, your how or what is irrelevant, because your why, if it's so big. And I heard Tony Robbins say that if you ask yourself that question 7 times, why do I want this? And then you give yourself an answer and then say why, and you answer that one, why, and you go 7 layers deep. And apparently when you're 7 layers deep into your why, that's like, when it
you're
comes
really
from the
there.
heart, so you got your why, you got your what, you got your how. What are we measuring, Julie?
So to me, there's 2 critical measures. One is your net yield. So I need to know how each property is performing, and it's what your net yield is. So what is effectively your cash flow that's coming out of the property. And the other one is if capital growth is one of the things that you're pushing, to understand what is the capital growth that you're actually getting on a property. And it's actually pretty simple to calculate and to track. It's just a matter of having the discipline of actually doing it.
Your net yield, the way you calculate it's a little bit differently to me. How do you calculate yours?
You have to be really careful with when you're using, and actually I think there's a slide coming that shows us, but it'll be further down. That's okay. And it's basically, I take all the property income, I get rid of, then subtract off all the property direct, what I would call property direct expenses, which is, your property management fees, it's your land tax, it's your maintenance costs. So you get what your net income is for a given property, and I always divide it by the current value, or my best understanding of the current value. And that's what's really important. For me, I always use the current value that has come from the valuations that I do with the bank. So I could just go into something like RP Data and get what the current estimate is within RP Data, but I have chosen to always be factual according to what my bank's last valuation was on a property.
Okay. Now, I calculate my net yield a little bit different, and I should probably call it cash on cash return, because I always manage how hard my equity in that deal is working for me, where you work on the property value, right? So if we've got 20% in a deal, let's call it $250,000, and it's creating 25 grand a year, that gives me a 10% cash on cash return. But if you've got a property worth $1 million and it's generating $50,000 a year, that's a 5% net yield, right? 2 different ways of doing it. Adam Barry, our friend Adam Barry, taught me the way that you did it, and I was thinking, interesting. Is there a right or a wrong way to do it? Both kind of give you a different measure and a different outcome, don't they?
I actually think they're both fantastic, and I certainly do cash on cash returns, especially for my development deals. But when it comes to judging my hold portfolio, it comes down to what level of debt do you have on it, and that's where it comes down to the cash on cash returns. So that's why I tend to use that for my developments, but I don't use it for my hold, because I make a decision about how much debt I want at the portfolio level. And so, the amount of debt you have makes that cash on cash return.
So if you've got a property that's negatively geared, your net return could be negative on some properties with interest rates where they are currently.
No, because my net yield does not take into account the interest rate.
Cost. Right, gotcha.
So I'm just purely looking for how does this property perform independent of debt.
Yes, gotcha. Okay. Love it. My cogs are ticking. This is it. This is me and you have these conversations because my brain just Love it. All right, so we've got an example here of a dentist.
So this is loosely based on my brother, who happens to be a dentist.
Right.
And I got really shocked, 10 or 15 years ago, when I had a conversation with him and he told me how much he loved his work. So a dentist is, typically a relatively high income individual. My brother loved his work. He wanted to work for as long as possible. And his whole reason for investing is that he just wanted to be financially free by the time he came to retirement. And that's a really important statement to make. So when we then look at, well, what's his vision, the why, the what, and how, his why, he wanted to be financially free at retirement. I've made up the what. This is me just putting words in his mouth, this particular part. And I went for 100K of passive income because as I talk to different property investors, 100K of passive income is the most common.
It's a good target. Yeah.
Metric or goal that actually people have. But my brother was really certain. He just wanted to hold residential property. And so he's busy with his work, loves his work, devoted to it, doesn't want to put a lot of, time and hassle into his property investing. So he just wants to, buy and hold residential property. He's not as fussed as some people about what is the level of cash flow that was actually coming, certainly while he's in the accumulation phase.
Yep.
That wasn't important to him. What was important is once he retired, he'd sell down to reduce the debt to give him whatever level of passive income he actually required. And it makes it understanding that, and the reason I put this as the first example is it just simplifies what you're looking at. And then I was hoping the next few slides are us going through the metrics so we can see what does that understanding of the why and the vision, how does that help you understand the actual metrics and the approach to your property investing?
Absolutely. Another dentist as well, high income.
Yeah.
Would he invest to reduce taxable income, or was he more investing to build wealth for the future?
I think, like me, he realised, you don't do things just for tax reasons.
Good. Sounds like a smart bloke.
No.
The tax advantages are just a bonus at the back end, aren't they, right?
Yeah.
Right, so capital growth equals wealth, cash flow pays the bills.
Yep.
And I've been saying on a few episodes of the podcast and on some of the social media stuff we've been putting out, you can't pay your bills with your balance sheet.
Correct.
Right.
The other point that I'd make here, so, as we've been talking about, capital growth is a thing that builds your wealth. If someone is building a property portfolio, at some point, even if you're a high income individual, you will run out of cash flow. So you've got to balance how your wealth is growing with how you're going to effectively service that portfolio. And also with capital growth, you're better off if you can leverage it. So if you own, let's say you've got $1 million, I always use $1 million because it's a one, so it's easy. It's easy for me to work the numbers out.
Not the same.
If you've got $1 million of funds and you buy $1 million worth of property and you get, say, 10% capital growth in a year, you've just made 100,000. But if you can afford to even take it up to a 50% LVR, so you're now buying, you've got $2 million property portfolio and you've got 10% capital growth in a year, you've now made 200,000. So if you're going down that capital growth, you really want to understand and leverage as much as you can. And as soon as you get into leverage, you've got to pay your interest, and that starts to have more of an impact on your cash flow. So then you've got to start balancing out your cash flow with your capital growth.
Yep.
And I can't remember one of the property gurus, he used to be big into commercial property, and his view was you have a commercial property and then you surround that commercial property with residential property. So that one commercial property is paying the bills to allow you to hold the different residential properties that have got the capital growth on them. And that's how you make money.
Makes sense. I've seen a lot of investment consultants and strategists, they say build your foundation of resi first, that gets high capital growth, and then potentially pay some of them down and leverage it into commercial as well. So different ways. I mean, there's, like me and you were saying earlier, there's so many different ways to do this. There's no right or wrong. It's just what works best for you with your risk tolerance, with your cash flow position, with your wealth position and your lifestyle. Because if you become too negatively geared, that will affect your lifestyle a lot. And my mentors were negatively geared at one point, and they sold down properties, converted properties, etc. And then that kind of got me onto the cash flow buzz and got me to where I am today as well. So but it's not for everybody.
Yep.
Like I speak to a lot of investors that don't want to invest in HMOs because they think it's too hard work, or you don't get capital growth, or
Yep.
this happens and that happens. So everybody's got their own perception, their own path. That's fine. I agree with that, and I wish them all the best, whichever route they take. I just want somebody to invest in property, whether it's with us or with somebody else.
Yep.
Just get in the market.
Yep. Or just invest, full stop.
Yeah.
Even if it's in shares, it doesn't matter.
Yeah.
We just all need to be better at investing.
Can't save your way to wealth.
No.
Correct. Right. So this is your portfolio approach,
Yes.
which we covered in episode 6, but we'll go through it again now.
Yeah, so I was just going to really quickly summarise it.
Yep.
So in my portfolio approach, I break things up into 3 categories of my low, my medium and my high risk. And really quickly, my low risk tends to be where I hold residential properties. The metrics that I've used ever since I created this was that I say net yield, I'm generally targeting at a 3 to 4% net yield out of my residential property. And capital growth, I'm generally looking for a 5 to 8% growth per annum on the property. So that's my residential. And these are the metrics that we mentioned earlier that I need to measure, and I think most people should be measuring.
Yep.
Then,
how do you track these? Have you got a spreadsheet that you put them in?
so interesting. So we'll actually come and see some of the stats. So I used to just do everything in a spreadsheet. Now all my properties really, my business just feeds into Xero. I've worked with my accountant. We've got the profit and loss set up properly, so that it just spews out what my net yield is, for example. And then I just also have a spreadsheet where I track what the capital value is, so I can see what it is. And I'm going to show in some of the later slides just extracts on those things. And I've just sort of extracted it and put them on the slides. That's how I've got the numbers, so I can reference them.
Awesome.
So I know what's going on, and I've got the numbers back to 2017, which when I converted from MyOb into Xero, and I've got all those numbers to hand.
Brilliant.
So it's fantastic.
Brilliant.
When it comes to commercial, generally I'm looking, I used to say a 7 to 9% net yield, but as we went through COVID and the yields were so low, I changed it to 6%. But I'm really looking for, that 6 to 9% or 7 to 9% net yield. And I expect the capital growth to at least keep pace with inflation. Yep. So that means it's got to be growing at, the RBA range of the 2 to 3% is what they're targeting for inflation. And that is really important. The other bit that I've not talked about last time is that often people talk about getting a 10% return guide per property. So if you're in the residential space, if you're getting, say, 3% as your net yield, you'd be trying to get a 7% capital growth. So you've then got 10% on your property. And if it's in the commercial space, if you're getting, again, 7% net yield now, you're expecting a 3%. Yeah, and that gives you that rough 10%.
Yeah.
So it depends, should you be holding commercial or should you be holding residential? Well, it depends what your needs are.
Yeah, depends what you want.
Yeah, it's why are you investing and what are you trying to achieve?
Yeah. We're not here today to tell you what you should do. We're here to get the cogs ticking.
It's just the
for you to
process.
start asking yourself these questions so that you can find out if and how you were stuck and what your options are moving forward.
Yeah. The last thing we haven't talked about is that I like to do developments. Developments to me are a lot easier than renovations. So developments is my preferred. And so that's the higher risk component of it. I like to do developments, and I generally try and hold some of my developments. If I'm investing in other people's projects, which is what my self-managed super fund does, I try to get a 20% return on my funds that are in it. So this is your cash on cash returns.
Yep.
When they're my own projects, I target 50% return per annum, cash on cash return on my projects. Don't always make it though.
How are the developments going at the minute?
There aren't any.
It's tight, aren't they?
It's really tough.
Are you seeing any green shoots? Like feasibility starting to look good again?
No, not in Perth. I'm really struggling to make Perth work. I really am. But I've got projects going in Victoria, but I've really moved into the commercial space. So we're getting some supermarket sites, and we're tending to be, and some childcare, we're tending to be focused on getting the development approval and actually acquiring the sites, having them under contract, and then selling them once we've got the DA.
Interesting.
It's fun. Nice. It's great fun.
Yeah. Very good.
So this point is simply saying that to recognise that your passive income, so the living expenses, you're paying your bills out of the cash flow that's really should be coming out of your residential and your commercial, your medium and your low risk investing.
And this is if you are living off property, which is obviously the name of your course.
Yes.
However, if you are still working, then you don't necessarily need to be using the cash flow from these portfolios.
If you're still working, you don't require the passive income. You're really chasing capital growth. But then you'll want the cash flow to make sure that you can hold that portfolio is what it's all about.
Yeah.
So, yeah.
And if somebody's not working and they are making, 25, 30 grand a year cash flow, what would you do with that, with your portfolio, if you were working and you didn't derive your income from your portfolio?
So I didn't quite get the question. You're saying someone has an income of $30,000 from a job?
Yeah, no, let's say they work PAYG $100,000 a year. They've got a property portfolio that generates them 30 grand a year cash flow positive.
Yep.
It's just hypothetical because right now at the market it's kind of tough to get them numbers. But what would you do if you were earning 100 grand a year working somewhere else and you had a property portfolio generating 30 grand a year cash flow?
Yeah, you need to look at your portfolio. Well, you need to go back to your goals. It depends what your goals are.
Yeah.
I'd be trying to use that 30,000 to acquire another property that has great capital growth if I was working.
See, for me, and this is the interesting part of it, right? I'd be using that 30k to pay down the debt on my portfolio as fast as I could. Extra $30,000 a year towards, $500,000-$600,000 debt. You'd extinguish that quite fast, right? Over time.
Yeah. But if I'm going for capital growth, so this is where we get some differences.
Yeah.
If I'm going for capital growth, I would rather have capital growth on that $2 million portfolio, which has got a 50% LVR on it. So often in businesses are often very comfortable having sort of 30%, 30 to 40% debt within their business. Different businesses have different metrics. But so for me, when I choose to hold a residential property, one of the requirements is my portfolio does not go over 50% of what I call my hold debt. And in actual fact, at the moment, I'm probably on somewhere between 20 and 30% actual debt on my hold portfolio. So I've got very low leverage in it.
Yeah.
But what I choose to do is I always then ask the bank for a 70 or 80% lend against those assets. So let's just go for the $1 million again. If you've got $1 million property portfolio, let's say I've got 30% what I call my hold debt. So that's the debt associated with the property that I'm holding. That means I've got $300,000 worth of actual debt. Let's say I've gone to the bank in this day and age, I'll get 70% LVR. So that means the bank is prepared to lend me up to $700,000, of which $300,000 is my whole debt. I've got $400,000 then of funds that I can, that is available to me. I can put my hot little hands on and go and do some development projects. What I would typically do is of that $400,000, I would try to have 200, so half of it, 200,000, I would be actively having invested in my development projects.
And look for a 50% return.
Yeah,
target.
to get the
Yeah.
So again, but if you come back to your, how do you juggle this debt and the use of leverage? You might not be happy with, and I personally would not be happy with a 70 or 80% debt on hold debt, but I'd be happy with a 50% debt on hold debt as long as it's cash flow neutral. And I'm very, very comfortable with a 20 to 30% hold debt. And in fact, I would go as far as saying once you've got your debt level below 50%, you're now really sacrificing your wealth creation from your capital growth by not having any sort of leverage. So it depends. It comes down to your risk profile, it comes down to your situation, and it comes down to what judgments you need to make and you want to make about where you're actually up to with your investing and what you're doing.
Again, there's no right or wrong way.
No,
it's just what works for you, right?
But it's understanding it as well.
Yeah.
And making that judgment for yourself. And I don't think you should rely on what other people tell you. I think you've got to build up and be able to make those decisions yourself.
Yeah. And by all means, ask the question, what would you
absolutely.
do? But you don't necessarily need to take that advice, guidance.
Yep. And I've heard some property gurus say, and certainly if you talk to some brokers, they really push people to go and get a 90% debt on a property. And that might be okay if the rest of your portfolio is not at 90%, but then I start to do a risk assessment against it. Go, okay, well, what happens if you lose your tenants? What happens if you lose your job? Where are you up to? How would you survive? And that's part of the risk management you need to do around it.
That's a big question I always think about when I see people that are negatively geared, because negatively geared property only works if you do.
Yeah,
the
that's
minute
right.
you lose your job, you lose the tax benefits, and you still need to pour the cash into that property to keep it afloat. So that's why I always want everything to be cash flow positive, because I never want to be in that position. Not that I'm going to lose my job unless I sack myself.
Yeah. But, things go wrong.
They do.
Yeah.
Yeah. On a
Things go
daily
wrong.
basis. Yeah. But I mean, as business owners, we're here to solve problems daily, right?
Yep.
Yeah.
Yep, absolutely.
So this is an interesting slide. We're talking about the difference of a net yield at different values of a portfolio.
Yes. So this came from, we're really going back now, specifically talking about that example where it was my brother and he was looking for 100,000 worth of passive income. And the reason for this slide, as you've mentioned, is to really help people understand the impact of knowing and understanding what sort of yields you're getting out of a property. So if you want $100,000 in passive income, and now we're just going to talk about a debt-free portfolio because it can get too complicated otherwise. And we just say, okay, well, what if you can get a 4% net yield on that property? And 4% net yield is something I typically can get on my apartments. If you can get a 4% net yield, you need 100K of passive income, then you need $2.5 million worth of property.
Yep.
If you're going and saying investing in Melbourne and Sydney, you'll often be lucky to get even a 1% net yield. And it was quite common for me to get 3% or even 2% on some of the houses that I've owned. Now, if you're owning houses and you've got 2% net yield and you want 100K of passive income, then suddenly you need $5 million worth of property portfolio.
Yeah.
And so people might sort of glaze over as we talk about numbers and the difference between a 2% net yield and a 4% net yield, because it doesn't sound that big a deal. But we're actually talking about the difference between $2.5 million of property or $5 million on property. And to me, that's huge.
Yep.
That's really significant. And it might be very achievable to get to 2.5 million. 2.5 million, but not so achievable to get to 5 million.
Yeah, I agree. Especially from leverage point of view as well,
absolutely.
with banks tapping people out in today's lending
landscape.
landscape.
Which comes back to the cash flow conversation again. So we could go around in circles on this for ever and a day. But I also then wanted to just bring back to capital growth as well. So let's just say you can get 4% off net yield off a property. To give you 100K, well, that 4%, if you're then doing, that 2.5 million, which was your 4%, when you look at capital growth, and we're looking at, say, maybe getting an 8% capital growth, 2.5 million, that gives you 200,000 a year. So your wealth has then gone up by $200,000 a year, while those properties have given you 100K to live off per year. So you're basically just earned 300,000 on that $2.5 million portfolio in a year. And if 8%, that is a little bit ambitious, but you can easily get 5%. It is very easy to get 5% capital growth. So even if you only get 5% capital growth from that $2.5 million portfolio, you've just made $125,000 in a year. And again, that's doubled the income that you just got off the property.
And you've made it in your sleep. You haven't had to work any harder.
It's just residential, so it's low risk.
Yeah.
So it's really quite simple to achieve. And to me, that is a fantastic scenario once you're in retirement.
Yep. And we're only talking about standard resi stuff. We're not talking about HMOs yet or anything like that.
No, we will get to that. But we're only talking about standard residentials.
Yeah. So this is if you're investing in 3x2s, 4x2s, etc.
Yep.
Rent them out for the standard median rent in that suburb and getting the standard return. Yeah.
Absolutely.
It's cool. I like it. It's good. like you say, 2.5 million is achievable, especially with the way prices are going at the minute. You know, buy a couple of properties, $700,000 each, and you're sitting there, aren't you? Cool.
Absolutely. Now, I put this slide in because I just wanted to really make a point and help to understand. So my brother's example, he really wanted to invest in residential, and his strategy was to, once he hit retirement, to sell down to reduce his debt to give him his income. Well, you can also have a strategy which is, you build up your wealth using residential property, but then what you're going to do is you're actually going to sell your residential property and you're going to go and buy a commercial property. Mm-hmm. Now, let's say you go and buy a commercial property. Remember, I gave the numbers net yield on commercial property. I generally expect somewhere between that 6 and 9%. If we use 7% as an example, if you want 100,000 passive income and you can achieve a 7% net yield on a property, that property is now, you only need 1.43 million. So we were talking about 4% you need 2.5 and 2% you need 5 million. Well, if you get into commercial, as long as you handle all the risk and all the rest of it correctly, we're now down to 1.43. So you might have leveraged your portfolio to make it work, and then you can sell down, get 7% return. You only need 1.43 million.
How easy is it to find a $1.5 million commercial property giving you a 7% return at the minute?
I'm going to show you that it's pretty easy.
Cool. All right. Awesome. But I wasn't trying to catch you out there, by the way. I was like, is it easy? So
it's very easy to get an HMO.
Yep.
And you can do commercial. You could definitely do a 6% net yield on commercial property, and that's 1.67, so it's not far off.
Yep.
But the other point, so because you've now switched to commercial, your capital growth might just be at 3%. So if you've got that 1.43, you're only making $43,000. But it is keeping pace with inflation so that your income will be pretty solid in terms of as you go forward and coping with inflation, which is obviously a big factor for people at the moment.
So you've probably got less cash in the deal. You're still making the same income that you need, but your wealth isn't increasing as fast.
Yeah. So your wealth is going to increase more from your residential portfolio, which, anyone who's going to inherit from you will really appreciate. But this is all about you, and this was really summarised back to the example of the dentist. He's chosen to invest in residential, and the next generation will love him because it will be a solid asset to actually pass on to people with intergenerational wealth.
Love it.
But you can also, if you don't have that amount of money, you sell it and you can go into commercial. There's different ways of doing it. I think we've actually talked quite a bit about the debt.
We did, you spoke about the 1 million property split into two. So going back to the approach,
so this is the approach that I use for my own investing, and we're now gone off the example of my brother, and we're just going to specifically talk about some of my own investing, and I'm going to quote some of my own figures to share with people, because I think you need the numbers and you need to see what has actually happened so that you can start to understand why this is important for yourself. And I have what I consider to be a very simple 5-step process. Step 1 is to define where you want to end up, which is basically have your vision, your strategy. It's the why you're doing something, the what and the how. The step 2 is to understand where you are now. So it's your sort of current state analysis of your finances, knowing the properties that you've got in your portfolio, how are they performing, but also what is your needs for income. So you need to understand your expenses as well as your income, and then you can start going and creating your investing plan and working out how you're going to do that residential investing or your HMO or your commercial. How does that work together? Then you need to make sure you're measuring the important statistics, and you need to be managing your risk. So for every asset that I hold, every property that I hold, I'm well aware what is the risks associated with this property, how am I going to stop that risk from occurring, what am I going to do to minimise that risk, and if that risk occurs, what is my contingent action. So they're the steps, and then you just got to keep repeating it. I have a business plan that I review and recreate every year, and I just keep going through it. I keep assessing each of the properties in my portfolio. Is this still meeting what this property is supposed to be doing within my portfolio? How is the measures going? What do I need to do? How do I need to change my investing? And that's what we're going to share with you.
Beautiful. Well, and these are actual properties from your portfolio, right? So
absolutely. And
perfect.
These slides that we've just created have literally, I've just gone into my business plan and I've cut and pasted them and put them into these slides. So, and the reason for doing that, and the reason for sharing what some people would judge to be pretty personal information, is I think you need to understand the numbers, and I think the only way people can really start to grasp the numbers and the significance of the importance of measuring things is to actually see the impacts and see how you use that data to actually make decisions.
Cool. Well, firstly, thank you, Julie, for sharing this with us.
I hope you find it interesting.
Yeah, I mean, I love this stuff. I could do it all day, every day.
Yeah.
In fact, I do.
Yeah.
So this one here, you're actually calling this a lemon.
Yeah. So these are actually two properties that I built back, I think they're around 2008. The intention was to hold one and to sell one, but I finished building them around the time when the GFC hit, so it was a terrible time to try to take them to market. So I've been just holding on to them, making a judgment, when should I actually try to sell one? And it was really to get back to that original plan of holding one and selling one.
Yeah. Can we just talk about, because you built these in 2008, yeah?
Yeah.
And they cost $1 million for the land and the build?
No. So that was when I finished building them, the valuation on a house, one of the houses, was $1 million.
Oh, nice. What was the development cost on them too? Can you remember?
Per house, it was $500,000.
Including the land?
Including the land.
Wow. So, and the reason that I wanted to stop you there and point that out is because right now property prices are expensive, right? Did that seem expensive at the time when you developed them?
No.
No, you thought it was cheap, 500,000 in 2008.
I was, well, see, I don't tend to make those sorts of judgments because I did a feasibility study.
Yeah.
So the feasibility study said, per house, the cost was $500,000, and the analysis of the market said that the end value of those houses should have been $750,000.
Yeah, okay. So it wasn't more about, is this expensive? Does it get me my return?
Yeah, it's just, is this delivering the return that I'm happy with?
Looking back now, does they seem cheap compared to the prices now?
I wished I could build.
This is what I'm trying to get at, right?
Yeah,
Are we gonna look at, so this is almost, let's say 15 years ago.
Yeah.
Are we gonna look back in 15 years time and think the prices now are cheap?
Yeah.
I think so too.
Oh, absolutely.
Yeah, I
no
think
doubt
so too.
about it. So as part of my process, every year I go through and I rank my properties. So I know which of the properties that are doing well, which ones aren't. Remember when I talked about the portfolio approach, I said roughly the rule of thumb was that my residential properties should be delivering between a 3 and 4% net yield.
Yep.
And my capital growth should be between 5 and 8%. And that across, there's roughly a 10% rule. So, a property should be delivering me, if you add those two numbers together, it should be basically 10%. So this was a lemon. So the total trading income, that's my total rent. So at the moment on that property, the total rent was about $47,000, but the cost of sales is around $24,000.
Yeah.
So that means all the what I would call property direct expenses.
Yeah.
So it's my land tax, my property management fees, my maintenance costs.
So if we take this from business lingo to property investment, total trading income would be your rental income.
My rent.
And total cost of sales would be your expenses.
Yeah, correct.
Yeah, cool.
The property expenses. So, and these are reports that are popping out of Xero, and it will show you that the net yield on this property is down to 1%, just slightly over 1% in 2023. Back in 2017, when I first loaded the data into Xero, it was getting a 2.2% net yield. When I first held them, they were getting close to a 3%, but they were just over 3% was their net yield on those properties. The other thing I just wanted to point out is when I first held the properties, 25% of the gross income was actually going on the property expenses. Now you can see that it's over 50% of my gross income is going on property expenses. So that's a huge change, and that's why my net yield has actually gone down so low. These particular properties are also in Brisbane. My land tax on the properties is about $9,000 per house.
Ouch.
Which means something about 20% of my gross income is now going on land tax. And these are the reasons why my net yield is so sad, because it's 1% net yield. So the reason why would you hold this property? You would hold it because you're getting really good capital growth. And if you look at what I've extracted from my spreadsheet, which is where every time the bank gives me a valuation, I always ask the bank what was the valuation that they got. I plug it into my little spreadsheet, and it is showing you that it's making about 6% per annum since I've held it. And that was based on the valuation that was given when it was finished in 2008. So it's giving me 6% capital growth, and it's giving me roughly 1% net yield.
So we're falling short of the 10% which we're targeting.
Absolutely.
Yeah, okay.
And I rank my properties, so these are at the bottom of my ranking. So I need to look at them and investigate and decide what am I going to do. Now, what also happens is there's this guy called Neil Gibb, and Neil and I would present at different conferences and at different property meetings, and he'd be there and claiming that you can get 10%, net yields off residential property, and I'd be scratching my head and going, really? So how do I make this happen? So it was like, so I consider this to be a lemon.
Yeah, okay.
Should say that, obviously, given the cost was $500,000, it's not a terrible lemon. It's just in judging where my vision is at the moment.
Yeah.
It's not meeting the metrics that I judge it by.
So what's the plan with this, Julie?
So that's what the next slide shows. So as part of the business planning that I did in 2023, went through and said, okay, I need to sell that property. Now, I hate selling property. I'm very good at selling things that I built that I never intended to keep. But once I make the decision I want to keep it, I actually find it quite hard to sell. Yeah. So it's just an emotional thing. They're my babies.
Well, lots of people, I speak to lots of people that are like this as well, right?
Yeah,
and I keep going back to the equity-rich cash flow poor scenario, because there's lots of people, if we go back to that slide there, you've seen some incredible capital growth.
Yes. Yeah.
But the cash flow is just dipping now, and you've made the decision, although it being emotionally challenging.
Yeah, very emotionally challenging.
To actually do what needs to be done.
It's probably worth mentioning on those particular properties as well. In that suburb, they are located in what I'd consider the 25% worst component of the suburb, which also means if I suddenly have a need to sell the property and it's in a market downturn in the property sector, it's going to be a challenge to sell those. So those properties do actually need to be sold when the market is warm to hot. So when another one of the reasons, it's not just the metrics, but it's also the risk profile of those properties that actually have it at the bottom of my list in terms of the value of the properties that I actually choose to hold.
Yeah. And how's the market in Brisbane at the minute?
Hot.
Hot. Good time to sell.
Yeah, well, so I sold it.
Yeah.
I have actually sold one.
Cool.
So the plan that I came up with back in 2023 was that I was going to go and start doing an HMO, and I was going to get the HMO first, because this is how I manage my emotions, and get the HMO actually up and running. And then, because when I sell my residential properties, you've got to get your tenant out. The property is well over 10 years, so it needed some, cosmetic reno work done on it. So I've got to organise that and then take it to market. Because it's actually any property that I would take to market, I will always dress it. So there's quite a bit of work to be done, and it takes a bit of time to actually do it.
Yeah.
So, and also when you do sell, there's some significant tax implications of that. So you do actually have to work out your tax implications. And I've got some pretty staggering capital gains tax that I needed to work through very carefully with my accountant and choose which financial year I was going to sell the property in to really manage that tax burden.
So if they cost you $500,000 and you're selling them for...
Oh, and then I've depreciated them.
Yeah.
So the cost basis is something like $300,000.
Yeah, right.
So it's pretty, there's a lot of capital gains tax that needs to be managed. So you've really got to plan that through. That's how you do it.
At the same time, it's a good problem to have, right? It means you've made money.
That's a fantastic problem.
Yeah. So a lot of people think, I never want to sell because I never want to pay capital gains tax, but you get a 50% capital gains tax exemption, which means 50% of it you don't even pay tax on anyway.
And that's another one of the risk factors.
Yeah.
So I'm convinced that at some point we're going to go down to a 25% relief. So remember the Labor talked about it for a while, and so there was a lot of discussion going on about, well, we're not going to give you a 50%. We're not just going to tax you on 50% of your capital gains. We'll only give you a 25%. What's the right word? Exemption. So we'll tax you on 75% of your capital gains. So if that came, So the implications of that for those properties was huge.
Yeah.
So it was another one of those. So there's all these drivers within that property, and my judgment on that property that I do every year was really pushing me to actually do something about it.
I was shaking my head there because I've started delving deeper into money and taxes and government, and it's just the amount of ways we get taxed. Don't get me started. We'll probably do another podcast on it eventually, but
Well, before they introduced the capital gains tax, they used to just, you would adjust your cost base for inflation. And I personally would like to see it go back to that basis, because I've held that property for, 15 or so years, and that's been, to me, a bit of a service to the community to actually provide properties that people can rent.
Yep.
But if you could make, but I'll get taxed based on 50% of my capital gain. If you were lucky enough to buy in Sydney and you held it for 12 months, you get the same tax concessions that I get who have held this property for 15 years. And I don't think that's fully fair. So I'd rather see them go back to the old way of doing it. But anyway, that's
let's not go down that rabbit hole.
So my plan, and I reckon I could turn that lemon around within about a year by going and getting an HMO, acquiring the HMO, getting that set up, and then turning around and selling my lemon. And in the medium term, my plan was to go and get another, and have about 2 or 3 HMOs in total. And so it was really all about measuring it, learning it, and reassessing it.
Yeah.
And I should admit now,
it is achievable, 2 or 3, 4, 5, 6 HMOs,
absolutely.
right? Your search criteria is very specific, which we'll talk about now, right?
Yes.
But then that specific search criteria is not causing issues, but we have to think differently again in the future what we do. So what is your search criteria, Julie, for a HMO?
So what I started with is I wanted to buy a site that I could subdivide it into 3. So that was the aim. I wanted to subdivide the site into 3, and I wanted a house that would go with 6 bedrooms, and I was trying to maximise my number of bathrooms. So I was really trying to get as many en-suited rooms as I possibly could, because I'm really targeting, that's another longer conversation, but I'm targeting that demographic of women over 55, who's the demographic that's growing the fastest for homelessness. And my view is women in particular of that age are more likely to want an ensuite. So that's what I was trying to do. So that was the search criteria. My son has been working with me for a couple of years now. It's going really well. And I set him the challenge of, okay, this is what I want, off you go and find it. And it took us over a year to find this particular property, which was very disappointing. And I changed the criteria, so we couldn't find anything that would divide into 3. So this particular property that we did buy, I can only subdivide it into 2. So we had to change it. The numbers still worked really well because it had a granny flat out the back, but the granny flat was not approved. So we needed to make that granny flat compliant as well.
There was a lot of work went into that.
A huge amount of work and cost.
And this comes back to, because people always ask me, can we convert garages? But to get them signed off as a habitable space, there's a lot that needs to be done. So we need a termite membrane under the slab. We need a double cavity or insulated wall on the exterior.
Yeah.
What was the problem with the roof again?
You've got to have the height clearance.
2.4.
Yeah, it's got to be 2.4.
2.4 metres.
It wasn't an issue with my granny flat, but we couldn't reduce. We had to sort of lift the roof we couldn't go into the roofs, but we had to keep the ceiling where it was.
Yes.
And we had a lot of insulation that went in. So we ended up having to put a new roof onto the thing.
That was it. I knew there was a roof thing that we had to address.
But the internal was 2.4. We've seen so many properties that have got granny flats on them that are non-compliant granny flats.
Yep.
And we know we cannot convert it.
Yeah.
You know, we just have to walk away. And it's actually heartbreaking because you see some places that have been done, people have done fantastic renos on these things and they look sensational, but, you know, they're not insulated properly or, you know, they're 2.3 metres height, so they're not a habitable area.
Yeah. See, you can do this. You can do it right or you can do it the wrong way, right? And unfortunately, I don't know whether some people are just ignorant or whether they just think, she'll be right, mate. We'll just do it anyway.
Yeah.
Hopefully we don't get caught. But obviously when you're treating it like a business, the last thing you want is unexpected expenses incurred because someone's knocked on your door and you haven't done the right thing, right? So.
Yeah, or tenants have an accident in your property and you find out that you were non-compliant, your insurance will probably not pay out. Mm-hmm. You could end up personally liable for any injuries to that individual. It's just not worth it.
Yeah. So we've got the duplex site here. Has it got the suburb on? You don't mind saying the suburb, do you?
No, the suburb is Morley for Perth people.
So people everybody now floods to Morley, checking Morley. This strategy works everywhere, right? So
but also people outside of Perth. Morley's sort of between Perth City and the airport.
I like Morley. Good, solid suburb.
It is a fantastic suburb.
Yeah.
So it was very
train line, train station coming in there.
Well, that was all part
soon.
of it. Yeah. So this particular property is less than 4Ks from 2 new train stations that are going in. One's close to the city and one's going towards Ellenbrook.
Cool.
So I only have, in my business plan, I only have 6 months of data because that's how long it's been running. Already I've made the judgment, this is absolutely a long-term hold. We'll keep it. The plan is to continue to rent it out for at least, as an HMO, for at least 20 years. And then probably the next generation can subdivide it when it's run its course of its life. Things that were interesting with it, the total costs on everything, the land and the reno and all the holding costs, because it was bought out of debt, was $1 million. I turned around and I got a commercial valuation done on it. And the commercial valuation was done on a 7.78% net yield. So that said the property was worth 1.22 mil in the end. So I made 20% return on my costs, which wasn't too bad for a reno, I think. So that was great. And the property it's been going really well. It's showing there that its gross income, sorry, no, not gross income, its net income in 6 months was $50,000. So it will be it's making me something over $100,000 prior to taking out the interest costs in a year.
Beautiful.
So it's given sensational returns.
Beautiful.
It's done really well.
So the problem is, like we said, we were specifically looking for a development site.
Yep.
Because you wanted, your original thing when you called me, you were like, I want to buy something, convert it, hold it, and then develop it in the future.
Yeah,
when
so I'm trying to
stacks
positive
up.
cash flow land bank.
Yeah.
That's what I'm trying to do.
Yeah.
So it's how can I make it all work? One of the challenge that I've really been left with, so there's probably 300 to 350,000 has sort of been sunk into this property, which has lost money to some extent. And that's what, because I'll turn around and, in 20 years, you're going to knock the building down. So then it's like, so 300,000 went into that, and that's really just going to be scrapped in 20 years. So then it's become, are you actually better off to buy? It's a trade-off. Do you spend the money to do the reno work and then you scrap it in 20 years' time to knock it down to do your subdivision? Or do you get a site, subdivide it now, and you build a brand new HMO, and then you hold that for 50 years?
Yeah.
I expect to hold a building.
The interesting thing is, we and I would say my business partner and I kind of step back from developments, and you said yourself it's been really hard to find anything to stack up, right? The only thing that we are finding stacking up is underdeveloping a site and putting HMOs on it that you don't need to sell. So obviously when we're developing, we need to develop for a certain margin. Typically, what do you look for on yours? We look for 15% minimum.
Yep.
And anything less than that gets hard to fund.
Yes.
With the HMOs, we're looking at them. You buy this block of land, you build a normal house on there, you're probably hovering around the 1 to 2% net yield range.
Yep.
We put a HMO on there, or let's say we've got a triplex site and we put 2 HMOs on, so we underdevelop.
Yes.
We don't maximise the development potential, we underdevelop. We're holding them properties and we're getting cash flow positive on a site that's still potentially got triplex potential in the future.
But your build cost would be over 600,000 per property.
Correct.
So then you're scrapping 600,000 when you eventually choose to build it.
Potentially, that's if you build it.
Yeah.
You could land bank it like this one here and unsell it to a developer, and you might make that 350 back that you sank into the renovation. So who knows? I'll get my crystal ball out and see what we can do. But
which is why it's all such a judgment. And it's so important to understand what your different options are.
Yeah. But if we look historically where the market's gone and where we think it's going to in the next 15, 20 years, like we looked at them properties in Brisbane and we thought they were cheap then, and now we're 15 years now and we'll look at what we're building today. It'll be cheap.
Yep.
Everything seems very expensive at the minute.
Yes.
But it's because everything just shot up the way it has. Interestingly, when I was thinking about the net yields on them properties early, the one thing that hasn't increased as fast as capital growth is rental income.
Oh, yes.
So if that jumps up, then that can sometimes offset that loss in the net yield that you're getting and can increase it. And then all of a sudden that lemon might not look so lemony. But to get from a 1.2, what was it, 1.2?
Yeah.
To get from,
but it's the value of the home that's a challenge.
Yeah,
and it's like,
'cause it keeps going
up.
up.
What can people afford in terms of rents?
Yeah,
and how much are wages going up?
Yeah.
And is the wages in relation to the value of the houses? So it's all those sorts of. We could have a social conversation about this now. We've gone forever, but it's a challenge.
But all in all, great outcome. 9.4% net yield.
Yep.
It's pretty good.
So it's. Well, that's on costs.
Yeah.
So I tend to say it's a 7. So it's a 7% net yield, 7.8% net yield on the value of the property. That's the number that I tend to look at.
So we've sold the lemon. We've took the cash out of there.
We've sold a lemon that was earning me 1%. Yep. So 1.1% was the net yield, and I've swapped it for a property that's giving me 7.78% net yield. So that's huge.
Yep. And you've had to overcome the kind of emotional discomfort of letting a property go.
When you've got a better result, that enables you to, it enables me to actually go through and actually sell something.
Yeah. And this all stems back to that podcast where I spoke about the lady with the $7 million portfolio, because a few small tweaks to that portfolio, and at the time she was 35k negative, probably around 75, 80 at the minute with interest rates. A few small tweaks to that $3 million equity that she got could have just built 3 unencumbered HMOs, delivering 70 grand each a year.
Well, it depends on what capital growth. Well, it depends on what her vision is, what she's trying to achieve. Yeah. And then it depends on, what is in her portfolio, what ones are giving her capital growth. Even if she just did one, then she would have had the cash flow to actually hold that with cash flow neutral portfolio. True. So it's getting that portfolio right.
True.
Depends what you're trying to achieve.
She could have also put that 3 million into 3 properties, potentially leverage them to buy something different as well. You could have bought 6 HMOs and then, happy days. So many different ways you can do this. There's no right or wrong, like we've said multiple times in this podcast today, but just thinking a little bit differently, and don't think you've made a mistake if you're stuck, because that's not true. Don't think you've done something wrong if you're stuck. Just take a step back and analyse and go, right, what is this doing for me? I really like the net yield approach, going from 1% or 1.19% to 7.78.
Yeah,
It's like,
absolutely.
it's incredible, isn't it?
Yep.
So what we're saying to you is sell all your properties and invest in HMOs.
No, we're not. That's what we're actually saying is you have a portfolio approach and you need a blend.
Yes, correct.
Yep. So you need to understand what you're trying to do and you just got to get a blend across it.
Yeah. But it's been really good going through this again, Julian. Thanks again for sharing these with us, because not many people would do this. What have we got next? It all comes back to...
Yeah, so we're going to keep going. We're going to... so we're now talking about the process that we talked about. That I always go through, and the fact that I replan every year, and I rank my different assets. So we're actually just going to show you 3 different examples. The first example is another house. This is, again, it's a house that I built 2 side by side back in, I think it was 2007. This particular house, so you can see there in 2017, it was still delivering that 3% net yield, which was within my range.
Perfect.
And I thought 3% for a house was really good. And remember, the goal was to have somewhere between a 5 and an 8% capital growth. You can actually see this house has done, since I built it, on average, it's ended up over the years 10% per annum of capital growth.
Solid.
So this is been a really pretty, solid performer. So the house was valued back in 2022 for about 1.7. So you think about, a 10% return on that. That means the house is making about 170,000 per annum in capital growth. And it had been given 3%, but because the values have gone up so much and the rent's not keeping pace, so the rent, I'm now back down to a 1% net yield. But this particular house is in another good suburb, just like the other one was a good suburb, but this would be in the top 25% of the area of that suburb. It's in a really desirable street. If I have a problem and I need to turn around and sell something quickly, this house would always sell. Even in a down market, this will sell very easily. So that all just factors into, that's my understanding of the risk, how it works out in this particular, for this particular asset. What's also happening at the moment, this house is currently going, Brisbane is really hot, and it's currently growing, capital growth is around 18% per annum. So it's
staggering.
It's absolutely staggering. So it's been my long-term hold, but I moved it from that hold to the watch. So I've really got to decide, should I continue with it when it's got a 1% net yield? But when it's making 18% per annum, there's no way I'm going to sell it. And given that it's made 10% per annum since I built it, and remember the lemon had made 6%. So that's a huge difference. So this house still fits pretty squarely in my, I've thought about it since I did the plan, but it's really still very squarely in my keep as part of my portfolio.
Yeah, good. Would you, with something like this, would you use some of the net yield from the HMO to make this look a little bit better, as in for the portfolio group?
Yeah.
Yeah.
So that comes back to the debt conversation, and I do my debt and I manage my cash flow at the portfolio level, not so much. So I judge a property at the property level, and then I look at my cash flow and I make things work at the portfolio level.
Yeah, gotcha.
So if the portfolio was struggling and it needed more cash flow, then you turn around and you'd have to sell it and swap it off for commercial or an HMO. So this is an apartment. I just wanted a range of things to actually share with people. Again, apartments I'd expect generally to be around a 4% net yield. The apartments I've generally found are not getting as good capital growth. There's a lot of property gurus around at the moment that actually believe that is going to have to change, and we're actually seeing signs of it starting to change because there's too much of a gap between the value of an apartment and the value of a house.
And there's no product coming on the market at the minute, is there?
You can't build in Perth. Well, anywhere.
Unless you're Paul Blackburn.
You can't build, well, it depends what market you're targeting, but your average market, you can't build apartments. That just doesn't work right now. Yeah.
So will that drive prices of apartments up then because of the scarcity or the lack of them?
Yeah, absolutely. So it's a shortage of housing. It's just going to drive them up. So if you actually if you flick back a minute, because one of the things that I didn't show on that one, you'll see on the little graph, so I keep as part of my spreadsheet with the values, we graph the values, and you can see that the value of the houses, it was static for a long time. This is from Brisbane, but it was static because we had the GFC and we had floods, and then it went back to its normal sort of fairly reasonable sort of growth, and then suddenly it's just boomed. So then we go forward to the apartment. The apartment had the same static for quite a while because that's just where the Brisbane market was, and then it started its growth trajectory, and I'm expecting it to do a bit of a jump.
Yeah, okay.
And so even at the moment, I'm still getting 3.5% net yield on it, and in fact, this year the net yield will go up even more because the rent's gone up so much.
But interestingly, the capital growth is sitting around 3% there, so you're under your 10%, right?
Yeah, I'm still significantly under it.
So at what point would you look at this and go, it's not doing what I need?
So
maybe time to move it on.
Absolutely. So it was interesting because it's the same sort of 6%-ish that I chose to sell the house. The house was roughly worth getting close to 2 million. The apartment's roughly worth about 500,000. So when you've got so much funds tied up into an asset, you make the decision quicker than this one. Also, the risk assessment, this is a lot lower risk associated with it, so I'm a lot more comfortable with that. So it's an apartment that it's actually a one-bedroom apartment that I actually have in this one. It's been very easy to rent. There's no real hassles associated with it. So it's a good, in terms of its risk, it's really good in that longer-term hold. I really like having a blend of different types of things in my portfolio. So it's good to have that sort of mix, which is why I'm quite happy to have the apartment in it. In terms of, I look into my crystal ball and where I think the market's going, and the value is currently below replacement value. So I believe that my speculation is that I'm going to get stronger capital growth coming through. So I think this will follow what the houses did, and it will eventually pick up. And certainly the yields would have already changed because we're getting better rent on them.
If we see a spike in capital growth, though, your net yield will drop, won't
Correct.
it? Because, So it could be sacrificed in the future.
Yep, it could be.
Yeah.
But again, it comes down to I've ranked my assets and where does this one sit in the ranking?
Yeah.
And to some extent, just because it's not worth as much, it doesn't get as much attention as a property that is worth more.
Yeah.
And what I can do with it.
As we've been talking, I use Monday.com for quite a lot of the things in my business. It's like this customizable, it's like a spreadsheet type of thing, but really cool.
Yep.
And I'm already thinking, I can build out a wicked Monday board with like the properties in there and like build a dashboard off the back for each one of them. Yeah, it's such a cool little tool.
Yep. And
going back to you cannot master what you do not measure, I use that to measure a lot of things, and I've got dashboards pulling in from all these different boards all over. Love it.
Yeah.
Love it.
Yeah, it's fantastic.
Yeah.
And the last one is I just wanted to bring a commercial into the discussion as well.
Yeah.
So remember, commercial is my medium risk portion of my investing. This is a property that I bought back in 2006, and it was a very old property when I bought it. So I've held this through the GFC, and I've obviously held it through COVID as well. It performed so well through the GFC. It was fantastic.
What tenants in there?
It's got 6 tenants, and the ground floor tenant is a bank.
Perfect.
So it's a blue chip tenant.
Long term.
The tenant's been there forever and a day.
Well, how secure is that? Because
Absolutely.
I cannot find a bank.
Yeah, I know.
It's getting harder and harder to find a bank.
I don't mind
open.
talking about the fact this particular property is in Launceston. It's in the Financial Street. It's about 50 metres from Myers, so the mall. So it's the tenants that are in there. There's actually, there's an accountant in there. There's a couple of different wealth advisors. There's some trainers in there. So there's some that are requiring still some face-to-face contact. My son and I have had all sorts of debates recently about, how important is that face-to-face contact and where is the market going, and will we just get to virtual reality when you put your headsets on and you don't actually ever have to go anywhere? So who knows? So you'll see that I've actually put in my plan, there is a risk. It's like, office market space is in decline. How much of an issue is it for this one? So it is a question. I've decided that for the next 5 years, I don't think it's a substantial enough risk to actually decide to sell it. The interesting thing, so if you remember from my standard metrics that I'm expecting for net yields out of commercial, I say 6 to 9%. This one has generally been delivering sort of 7 to 8% consistently as its net yield. And the 2018 data is at 7.8, and at the moment it's running at about, according to that, 7.37% is the net yield. So it's squarely in there. The thing that's really surprised me, I expected commercial, and talking to a lot of commercials, those experts, were expecting my capital growth to be between that, keeping up with CPI, which is 2 to 3%, because as the rents will go up in accordance with inflation. So that, by definition, drags the value of your building up. But there's been a change. There's been pressure on net yields. So when I bought it, it was supposedly bought on a 10% net yield. I think it only ever delivered 9% net yield for a while there. But then, when if net yields were going down to 6 and 7% at one point for this type of a product. And so because of that net yield dropping really increases the value of the property. So because we're accepting lower net yields now, it's dragged the capital growth of the property up. So this particular property has been growing by 8% per year. That means this one has been growing by 15% per year since I've had it in 2006, which is just, to me, it's absolutely mind-blowing.
Yeah.
It's fantastic.
And going back to the start of the podcast when we were looking at that portfolio approach, and I said, can you get a commercial property for 1.5 mil that delivers a 7% return?
I did.
There you go.
Yeah. This is it. It's pretty, yeah. And so this, you wouldn't get that, say, in Sydney or Melbourne CBD, but you do get it in regional areas.
Yeah.
And I engaged a buyer's agent, so absolutely, always, I try to do as little as possible myself.
Yeah.
And I'll use people who are experts in their area. So when I did the HMO, I didn't do the reno work. I found it because that was something that was very specific to my criteria. But I used you to get the reno work done. When I went to buy my commercial property, I used a buyer's agent to go and to find me a really good commercial property.
Yeah. Well, that's what people are there for, right? Use the experts.
I think they save their fee.
Yeah.
Basically.
Absolutely.
Yep.
What about next?
So this was just trying to come back and wind thing back to, the reason why we're talking, and that example scenario where people were losing the $35,000 a year on their portfolio, and they had a $7 million portfolio. And hopefully we've shown how you can actually solve it. And there's different ways of doing it, but the simplest way, if you want to go to the next slide, was that you could take $1 million, exactly what I did with my lemon. You choose the asset in your portfolio that's sort of at the bottom of your rankings of how good that property is or isn't, and then you swap that for an HMO. And if you took $1 million out and you just swapped it to $1 million HMO, you would wipe out the cash flow shortfall that you actually have with one property. So it's relatively simple to do. And if you don't want to do an HMO, you could go and do a commercial property, the same sort of thing. Yeah.
Beautiful. Have we got any more slides? I think lots and lots of content in there. I've loved this conversation, by the way. I always say, and I remember when I first got into this space, people always said, have mates, friends in the game. Yeah. Because, they pull you up to their level. You have some really good conversations with them. They challenge the way you think. Yep. You become good friends with them. Yeah. Yeah. It's, I've loved this conversation, Julie. I really have.
Yeah. Well, it's been fantastic.
Well, we've been going an hour and 20 minutes as well. So
we've gone rather a long time.
That doesn't matter. I knew it was going to, but I don't think the people that are listening will mind, because there's a lot of value in there, a lot of ways for people to kind of question themselves now and ask themselves different questions, because they've heard how me and you would approach certain things.
Yep.
Loved it.
Yep. And hopefully people will take away the message that you need to take control of it yourself, that there's many ways of solving something, and you've really got to ask yourself why you're doing this, what is your vision, and how are you going about doing it, and then measure and actually get some facts that force you to make the right decisions that suit your scenario.
Yeah.
And so you can bring in advisors, you can get help, but ultimately you're the one that's got to do it.
Set goals, take action.
Yeah, pretty simple, isn't it?
Measure.
Yeah.
And measure. You cannot master what you do not measure.
Correct.
Say it all the time. Julie, It's been an absolute pleasure. We have got a little special offering for anybody that, is feeling stuck or feeling a little bit lost, or they might have hit a few brick walls. And we would like to help, me and Julie. And again, we're not financial advisors or anything like that, but we are two avid property investors that have done a fair few deals between us.
And we just love talking about property.
And we love talking about property. We love helping people. Yeah.
Yep.
So we're willing to help 3 listeners from the podcast who might be in a bit of a pickle, stuck, tapped out by the banks, could be just starting. We really need them to have a portfolio so we can look at the portfolio. Yep. We're not really taking anybody from 0 to 1, are we?
Yep.
Yeah.
Well, we could.
Yeah. If they've got cash.
Yes.
Yeah. But if you've got no money, then we need to start doing creative deals. I don't think we're going down that path.
No.
But if you have got cash to invest, and look, might not be HMO, I don't think we're going to try and push you into anything like that. You've seen Julie's portfolio there.
Yep.
And if you can tell us what your challenge is, you can reach out to me, Neil, at the HMOPropertyCo.com. That's my personal email. Send me a little bit of blurb on you and your portfolio. And if you're open to it, me, Julie, and yourself would record a Zoom call and then use it as a podcast so we can show the people how we've helped you see your portfolio in a different light and the steps that we'd both take. And I dare say that me and Julie would potentially take different courses of avenue from the same portfolio. So again, there's no right or wrong way.
Well,
it's
it
just
will depend on
you.
what you're trying to achieve.
Yeah.
So
the 3 of us on that call might all take a different avenue, but me and Julie could ask you questions that could question your thinking. That's challenge your thinking, not question your thinking, challenge it.
Hopefully allow you to discover ways of getting over whatever the challenge is that you're currently facing.
Yeah. And we might strip it right back to goal setting.
Yes.
Why are you doing this?
Yep.
But if you're keen, let us know. Reach out to me, Neil, at the HMOPropertyCo.com, and we would love to have a chat with you and see if we can help.
Yeah, and we'd have a lot of fun having those conversations.
I would love it. That's it. That's the end of it. So I'll leave that one there. Julie, thank you very much again. Oh, something just popped up on my screen.
Thank you. It's so much fun.
It is. And like you say, we've been an hour and 20 there. I feel pumped now. I'm ready to go out and buy some more properties or something. Julie Taylor, thank you very much. Join us again next week, guys. Actually, episode 100 next week.
Oh, wow.
Wow. And like you say, you were episode 6 2 years ago. So thank you again, Julie. Join us again next week on the show, episode 100. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.